What if I told you that the very bank where you keep your life savings is secretly making massive high stakes moves in the world of cryptocurrency? You've probably heard the official story. Maybe you've seen the warnings on their website. Cryptocurrency is volatile, a highly speculative asset not suitable for most investors. They paint a picture of a dangerous, unregulated Wild West, a place where your money could vanish in an instant. But while they're telling you to stay away, behind the scenes, they are locked in a crypto arms race. They are building, investing, and strategizing at a level that would shock most of their customers. In this video, we are pulling back the curtain. We're going to expose the complex risk strategies your bank is adopting right now. We'll reveal the real reasons for their secrecy, and most importantly, we'll uncover what it all means for your money. Because what they aren't telling you is far more important than what they are. The secrets they're keeping could redefine the future of finance and your place in it. This isn't some far off abstract financial story. This is about your bank, your money, and a silent revolution they are hoping you won't notice until it's already over. Stick with me because we are about to expose the blueprint. Let's start with the story they want you to believe. For years, the titans of traditional finance have been publicly skeptical, if not outright hostile, toward cryptocurrency. Think back to the not so distant past. You had JP Morgan Chase's CEO, Jamie Dimon, famously dismissing Bitcoin, even as his bank is now a major player in the underlying technology. You had a chorus of bankers and financial advisors warning Main Street investors about the perils of digital assets, framing it as a gamble, not an investment. They positioned themselves as the responsible adults in the room, the sober guardians of a financial system that crypto was supposedly trying to burn down. For the average person, the message was crystal clear. This is a space for gamblers and tech fanatics, not for serious people with serious financial goals. Your savings account is safe, your 401k is sound. Don't get distracted by these shiny, new, and dangerous digital toys. This narrative was incredibly effective. It created a deep sense of distrust and confusion around crypto for millions of people, making them feel secure within the walled garden of traditional banking. But what happens when the gardeners start secretly planting the very seeds they warned you were poison? That is exactly what's been happening. Behind the closed doors of their boardrooms, a completely different conversation has been taking place. While their public relations departments were issuing warnings, their strategy and technology departments were given a very different directive: get us into crypto and do it now. The evidence is overwhelming when you put it all together. We're not talking about small experimental projects. We're talking about a fundamental, systemic embrace of digital assets by the largest financial institutions on the planet. Look at JP Morgan Chase. The same institution whose leader was one of crypto's biggest critics now operates Kinexes, an institutional blockchain platform that already processes over $2 billion a day. It uses its own JPM coin to let corporate clients settle payments instantly, 24/7, completely bypassing the old, slow banking rails. This isn't a small pivot, it's a tectonic shift. They aren't just dipping their toes in the water, they are building the plumbing for a new financial ocean. And it's not just JP Morgan. It's a cascade of dominoes. BNY Mellon, America's oldest bank, launched its digital asset custody platform back in 2022 and has been integrating blockchain analytics tools ever since. US Bank just resumed its crypto custody services for institutional investment managers, citing greater regulatory clarity. These are not fringe players, these institutions are the very bedrock of the global financial system, holding trillions of dollars in assets. Goldman Sachs, another giant of Wall Street, is deeply involved. They recently completed the first ever over the counter crypto options trade between two major banks with DBS. This is an incredibly sophisticated financial maneuver, the kind of thing banks do to manage risk on billions of dollars in exposure, and it signals a true interbank market for crypto derivatives. Even Bank of America, which has been historically conservative, is now publishing reports like On Chain, shining a spotlight on Ethereum's potential for stablecoins and tokenization. So, what are we to make of this? On one hand, you, the retail customer, are told to be careful. On the other hand, the institutions you trust with your money are not just investing in crypto, they are building the fundamental infrastructure to support it, trade it, and secure it at a massive scale for their biggest clients. They are building custody services, which are essentially fortified digital vaults. They are creating trading desks for sophisticated derivatives. They are even exploring issuing their own stablecoins. This is the great disconnect, a blatant information asymmetry. They are creating an us versus them financial world where they, the institutions, have access to the tools, the infrastructure, and the profit potential of a new asset class, while the general public is fed a narrative of fear and caution. The question you have to ask yourself is why? Why would they publicly downplay an asset class that they are privately spending billions to integrate into their core business? Why the secrecy? The answer isn't simple, but it reveals a strategy that is as brilliant as it is self serving. And understanding that strategy is the first step to understanding what's really happening to your money. So, how exactly are they doing it? How are these massive, traditionally slow moving institutions building their crypto empires, all while keeping their retail customers largely in the dark? It's not a haphazard gold rush, it's a calculated, methodical, and incredibly sophisticated operation. They are constructing what can only be described as a crypto fortress, designed to manage immense risk and to ensure they remain in control. And they're using a specific blueprint, one that relies on caution, control, and a whole lot of fine print. Let's break down this secret blueprint. First, there's what I call the velvet rope strategy. This is their approach to onboarding clients, and it's all about extreme selectivity. When a bank decides to enter the crypto space, they don't just open the floodgates. Instead, they act like a bouncer at the world's most exclusive nightclub. They start at the lowest risk level, perhaps offering basic banking to companies adjacent to crypto, but not directly touching the assets. Think consulting firms or software developers. Once they gain confidence, they slowly open the door to highly regulated and compliant crypto exchanges. Only after mastering that level do they even consider expanding to a broader set of crypto businesses. This graduated process allows them to learn and adapt in a controlled environment. They use these early clients as a training ground, refining their monitoring systems and building expertise before taking on more complex risks. It's a slow, deliberate crawl into the market, not a sprint. For the average person, this process is completely invisible. You don't see the pilot programs or the closed door meetings. All you hear is the public silence. The second part of the blueprint is what I call old walls, new bricks. Instead of building a brand new compliance department for crypto, banks are integrating it into their existing formidable risk management frameworks. They are reinforcing their old trusted walls with new crypto specific bricks. Their primary weapon here is their anti money laundering program. These are the systems banks have used for decades to detect and report suspicious financial activity under laws like the Bank Secrecy Act. Now, they are extending these exact frameworks to cover crypto, plugging in powerful blockchain analytics tools from companies like Chainalysis or Elliptic directly into their monitoring systems. So, when a crypto transaction comes through, it's not being analyzed by some new, untested algorithm. It's being scrutinized by the same robust, regulator approved systems that monitor billions of dollars in fiat transactions every day. This approach is clever, it's cost effective, but more importantly, it gives them a defensible position with regulators. They can say, we are applying the same high standards of scrutiny that we apply to all financial assets. It's about taming the Wild West by forcing it to play by the old world's rules. That brings us to the most critical part of the fortress, the digital vault. This is where banks are pouring immense resources to deal with the single greatest risk in all of cryptocurrency, the safekeeping of the assets themselves. In crypto, if you lose the cryptographic keys, you lose the money forever. There's no forgot password button. The loss is absolute. Banks understand this, and the liability of losing billions in customer assets is a nightmare scenario. So they are building digital vaults with unprecedented levels of security. We're talking about a multi layered defense system for managing cryptographic keys. This involves things like multi signature or multi sig wallets, where multiple independent parties have to approve a transaction. Think of a bank vault that requires several different key holders to be present to open it. They use a combination of hot wallets connected to the internet for liquidity and cold wallets kept completely offline in physically secure locations to store the vast majority of assets. They also have robust internal controls, comprehensive cybersecurity frameworks, and detailed contingency plans for every conceivable disaster. This obsessive focus on secure key management is why institutional clients are willing to pay banks significant fees for crypto custody. They aren't just paying for storage, they are paying for peace of mind. But this is also where the secrecy serves them. The specific details of their key management protocols are among their most closely guarded secrets, as disclosing them would create a roadmap for potential attackers. This necessary secrecy conveniently bleeds into a broader culture of non disclosure about their overall crypto activities. Finally, all of this is wrapped in a thick blanket of regulatory oversight. Banks are in constant dialogue with regulators, conducting thorough risk assessments for every crypto activity and documenting every control. Every new crypto product has to be approved at the highest levels of the bank. This creates a massive paper trail, but it's a trail designed for regulators, not for you. When you piece it all together, the velvet rope selection, the integration into old AML frameworks, the impenetrable digital vaults, and the constant documentation, you see a clear picture. Banks are not afraid of crypto anymore. They have a blueprint to tame it, control it, and absorb it into their world. Their silence isn't a sign of inaction, it's the silence of careful, deliberate construction. By the way, if you're finding this breakdown of the bank's secret crypto strategies eye opening, make sure you hit that subscribe button. We're constantly digging into how the world of finance is changing and what it means for you. This is a fast moving space, and we're committed to bringing you the stories you won't get from the mainstream. Your support helps us keep pulling back the curtain, so join our community and let's navigate this new landscape together. Now, let's get back to the biggest question of all. Why are they doing all of this? We've seen the disconnect between what banks say and what they do. We've dissected the secret blueprint they're using to build their crypto fortresses. But that brings us to the most fundamental question: why? Why are these massive, risk averse institutions now pouring billions into conquering this new world? The answer is a complex cocktail of fear, greed, and a deep seated instinct for survival. The first and most powerful motive is the crippling fear of being left behind. Banks have seen what Netflix did to Blockbuster and what Amazon did to retail. Deep down, they are terrified of becoming the Blockbuster of finance. For the past decade, they've watched nimble fintech startups and crypto exchanges chip away at their business. They saw the promise of decentralized finance, or DEFI, which aims to replicate core banking services without the bank as a middleman. Initially, they could dismiss it, but as the crypto market grew, the threat became existential. The turning point was when their most valuable clients, hedge funds, corporate treasurers, and high net worth individuals, started demanding access. It's one thing to ignore retail enthusiasts, it's another when your biggest customers are asking, "What is your strategy for digital assets?" At that point, standing on the sidelines was no longer an option. It was a fiduciary failure. They had to get in the game, not because they suddenly believed in the philosophy of Satoshi Nakamoto, but because they were driven by a primal fear of becoming obsolete. Of course, where there is fear, there is also immense greed. The second major motive is the hunt for new lucrative revenue streams. The traditional business of banking has become a notoriously low margin game. Crypto represents a treasure trove. Consider the fees. The market for crypto custody alone is a multi billion-dollar industry and is growing rapidly. Banks can charge significantly higher fees for safeguarding digital assets compared to traditional stocks or bonds because the security risks and expertise required are so much greater. Then there's trading. By facilitating block trades or engaging in sophisticated derivatives like the options trade between Goldman Sachs and DBS, banks can generate enormous trading revenues. The volatility that they warn you about is actually a feature, not a bug, for their trading desks. Volatility creates trading opportunities, and trading opportunities generate profit. Then there is the entire ecosystem of tokenization, creating a digital version of a real world asset on a blockchain. BlackRock, the world's largest asset manager, is actively pursuing tokenization, with its CEO stating that the goal is to tokenize every financial asset. Banks are positioning themselves to be the primary platforms for tokenizing everything from real estate to private equity. Imagine taking a small fee every time a fraction of a commercial real estate building is traded 24/7. The potential revenue is almost unimaginable. The third motive is the inflation hedge narrative. With unprecedented levels of monetary stimulus from central banks, concerns about currency debasement and inflation have grown, not just among crypto enthusiasts, but within the highest echelons of finance. Institutional investors are actively seeking assets that can act as a store of value. Bitcoin, with its fixed supply, is seen by many as a form of digital gold. Whether you agree with this narrative is irrelevant. What matters is that people with the most money are acting on that belief. Banks, as service providers, are simply responding to this powerful demand. Even BlackRock has noted that a small allocation to Bitcoin could help diversify institutional portfolios. Finally, and perhaps most cynically, is the motive of control. The original promise of Bitcoin and DeFi was to create a system without intermediaries like banks. It was a direct threat to their power. So their strategy becomes clear. If you can't beat them, join them and then co opt them. By becoming the primary custodians, regulated trading venues, and on ramps for institutional capital, banks can reinsert themselves right back into the center of this new financial world. Once embedded, they can shape the ecosystem in their own image. They can influence regulation to favor large players like themselves. We see this with the travel rule, a traditional finance regulation now being applied to crypto that requires institutions to share information on fund transfers. This is easy for a bank to implement, but incredibly difficult for a small DeFi protocol. By controlling the flow of institutional money and shaping the regulatory landscape, banks can ensure that the crypto revolution doesn't sideline them. Instead, it becomes just another asset class that they manage, control, and profit from. So, what does all of this, their secrecy, their strategy, their ambition, actually mean for you, for your savings, and for your financial future? The implications are profound. First, let's talk about the risk to your money that you never explicitly signed up for. Banks are presenting themselves as the safe, regulated entry point into crypto. They emphasize their robust risk management and secure custody. And while their systems are sophisticated, no system is infallible. What happens if one of these major banks with significant exposure to crypto markets suffers a catastrophic failure? What if there's a security breach that bypasses their defenses? While your personal deposits might be insured up to a certain limit, the bank as a whole is now taking on a new, highly complex risk profile. This is a hidden risk, an exposure that is not transparently communicated to their regular customers. You might have chosen a safe bank precisely to avoid this kind of speculative risk, but your bank may have chosen to take it on without ever asking your permission. Second, and more fundamentally, their strategy creates a massive information asymmetry. This is the core of the keeping secrets problem. They have teams of analysts and traders working around the clock to understand and profit from the crypto market. They have access to the best data, the most sophisticated tools, and a direct line to regulators. Meanwhile, what does the average retail investor get? A warning on a web page. This creates a two-tiered system. The institutional clients get access to the potential for outsized returns through sophisticated products and expert guidance. The retail public is left to navigate the choppy waters of public exchanges with incomplete information and a distinct disadvantage. The bank's secrecy isn't just about protecting trade secrets, it's about maintaining a crucial edge. It's not a level playing field, it's a field they own, and they're just renting out small, fenced off sections to the public. Third, we have to consider the coming regulatory moat. Now that banks are firmly in the crypto game, they will actively lobby for a specific kind of regulation that benefits them. They will advocate for rules that are easy for a multi trillion dollar institution to comply with, but are crushingly expensive for a startup. Think of capital requirements and extensive reporting standards like the travel rule. These are things banks already do. For a small team of developers, it can be a death sentence. This creates a regulatory moat, a barrier to entry that protects the incumbents from competition. By shaping the laws in their favor, banks can cement their control over the industry, ensuring it evolves into a market dominated by a few large players themselves. The disruptive, democratizing potential of crypto gets neutered, and the system ends up looking a lot like the one we already have. So, what can you actually do? This isn't a call to abandon the banking system, it's a call for empowerment through awareness. First, start asking direct questions. Ask your bank, what is your institution's policy on cryptocurrency? Do you offer crypto custody services for institutional clients? What measures are in place to ensure the bank's stability isn't at risk from its digital asset activities? They may not give you a straight answer, but the question itself sends a message that customers are paying attention. Second, educate yourself from independent sources. Learn the fundamental differences between holding crypto on an exchange, in a self custody wallet where you control the keys, and through a bank's custodial service. Each has a different risk profile. Self custody gives you full control, but also full responsibility. A bank's custody service offers convenience, but means you're ceding control and are subject to their rules and risks. Understanding these trade offs is the most important step you can take. This isn't about being for or against crypto. It's about being for transparency and your own financial sovereignty. The banks have their strategy. It's time for you to have yours. So, is your bank keeping crypto secrets from you? The answer is an unequivocal yes. But it's more than just hiding a few trades. We've uncovered a deliberate, multi year strategy to absorb a revolutionary technology into the traditional financial system on their terms. We've seen the great disconnect. The chasm between the cautious warnings they issue to you and the aggressive multi-billion-dollar infrastructure they are building in private. We've exposed their blueprint of secrecy, a meticulous plan built on a velvet rope strategy for clients, reinforcing old compliance walls with new crypto bricks and building impenetrable digital vaults. And we've laid bare their motives, a potent mix of the fear of being disrupted, the greed for new revenue streams, the need to meet client demand for an inflation hedge, and the ultimate goal of reasserting their control over the future of money. This isn't just a story about finance. It's a story about power. It's about who gets to write the rules for the next generation of our economy. The banks are not just adopting crypto, they are attempting to tame it, sanitize it, and mold it into a system that perpetuates their role as the central gatekeepers. The secrecy they employ is their most powerful tool. It allows them to build their position, manage their risks, and influence regulation, all before the public fully understands what is at stake. But their secrets are now out in the open. The silent war for the future of money is being waged right now within the marble halls of the institutions you trust. The question is no longer if your bank will become a crypto bank. They already are. The real question is what this new reality means for you. Will you be a passive spectator, or will you be an active, educated participant ready to navigate the landscape with your eyes wide open? The future of finance is being built as we speak. Now, you know who the architects are and what they're secretly building.